Well, hi, everyone. My name is Bronson Hill. Welcome today. I'm the Director of Investor Relations at Nighthawk Equity, and I'm joined with the one and only Michael Block. Welcome
Well, what's going on, Bronson?
in the house.
In the
Uh,
house.
so one question that comes up, Michael, and again, how much we love talking about passive investing and about investing in general, but how much skin in the game, or why is it important for a sponsor, a syndicator to have skin in the game, and what does that mean?
Yeah, skin again essentially means how much of their own capital are they investing in a deal, right? It's a fair question, and sometimes investors will ask the question. The question really is how important is it that they do or that they don't, and if so, how much, right? And really the reason that investors ask is they want to know how confident is the sponsor in their own deal, and how much vested are they in the deal. So the thinking goes that if the sponsor invests their own capital, then they're more incentivized to actually make sure the investment is good. Meaning that if they lose money, then the investors lose money, then they also lose their own money, which seems to make investors feel good, and that's why they're asking these questions.
Gotcha. And so why would a syndicator want to put less money into the deal or less skin in the game, and is that a deal breaker?
No. I mean, obviously, look, as a syndicator, there's no better place to park our money than in these syndications. The question is, why don't we always do it, right? Why doesn't every operator always put the minimum investment amount in there? And typically, it's not so much that they don't want to; it's that they're not in a position to put money in. And the reason is that liquidity is really important as an operator for a variety of different reasons. Number one, for example, you need a certain amount of liquidity for the loans. You need a certain amount of liquidity as an emergency fund if something goes bad, right? So those are some of the. You also need liquidity to put deposits down on new deals. So you might be putting $100,000 down on a new deal. If you don't have that cash, it puts you in a very difficult position. So if we're putting bids on multiple deals, that can easily exhaust. And we're doing diligence on one. We have one on a contract. It could tie up $300,000-$400,000 pretty easily. So it's a fair question, though. The investors, well, how much are you putting in? None. Why not? Okay, and so if there's like, well, I don't want to because I don't believe in this deal, then that's a red flag. But typically, at least in our case, if we're not putting in money or we're putting the minimum or we're putting less than minimum in, it's typically around these issues around liquidity because it's really important in order to preserve deal flow to have liquidity.
This is one thing I didn't really understand until I really started doing more deals is just the liquidity requirements and if you need a $10 million loan, they'll come to the partner and say, you need $1 million in cash right now in non-invested capital. And, that can be a little challenging to do. So having, especially because we're doing multiple deals per year, sometimes multiple deals at the same time, having that can be really, important. So Michael, how important is skin in the game then?
Well, so what at the heart of the question is how aligned are the general partners or the operator with the limited partners. That's really what it is. If in other words, how much is the general partners going to care about the deal? And if the deal goes south, will the general partner be affected just like the limited partner, or could they simply just walk away? And that's really at the heart of that question. So let's just take that apart a little bit here. The skin in the game is it's nice, but really what's more important is that the GPs have liquidity. So it's nice to have the GPs money in a deal, but if they don't have liquidity, it can be an issue. Liquidity to do more deals, but what happens if something doesn't go quite right with the deal? And let's say it requires more capital. One of the things that general partners don't want to do is we don't want to do what's called a capital call. I mean, we don't want to call up our investors and go, gosh, something went wrong. Something's not going right. We need another $500,000. Everybody put money in. Like, we don't want to do that, right? What we're more inclined to do is simply to pay for it out of pocket, either as additional, not so much equity. Maybe we're loaning to the business. So liquidity is really, really important. The other thing is you got to make sure that the interests are in line, so that the GPs are in fact motivated to do a good job. And one way is to make sure that, for example, the equity is aligned and the fees are in line. So in other words, if the property makes money, the general partner should make money as well as the limited partners. A sign of misalignment is if when the property makes money and the GPs make money, but the LPs, the limited partners don't, for example, or even the other way around. The limited partners make money and general partners don't, which happens with preferred returns, for example. That's also a misalignment. Also remember that the GPs don't make any money in the deal really their equity is worth less until they have forced the appreciation of the asset. So if an investor, if the general partners own 20-30% of the deal, for example, that equity won't become valuable unless that deal has become has gained enough value. So the general partners are very, very incentivized to make that equity worth something, because if they don't, it'll be worthless and we're working for free. Also keep in mind that the general partners are guaranteeing the loans as well. So keep that in mind. If there's ever a default situation, the limited partners, they might lose part of their, or maybe even all of their capital, but the general partners now have lawsuits on their hand. So the downside is very much, could be very severe for GP. So it's really much alignment. And so while it's worthwhile asking how much skin in the game, it should not be a showstopper from the passive investor to invest in a deal.
Thanks for sharing that, Michael. I think it's really true you said about aligning interests, and really the way I look at it too is that, we'll raise $5 million for a deal and somebody puts 50K or 100K, and it's not a significant amount of the actual total deal. It's significant to each investor, but basically when there's a long-term partnership model that it's, from us as, general partners and even as a limited partners, like we're really looking at this is that we want this to perform well because of that relationship we have with our investors. We want to do more deals together. We want that kind of thing. So I think when you get that sense in speaking with a syndicator that there is a long-term partnership mindset, and there's a sense of like, we just really want to make sure that we treat our investors very well, then that will help in that situation. So any last comments, any takeaways from all of this? The last things you wanted to share?
Yeah, no, not really, but it's very positive that to ask the question again. Don't use it as a showstopper, but if someone's not putting in money, ask why, and it could be one of those reasons. If they don't come up with a good reason, then it could be potentially a red flag that they don't have any confidence in the deal. But typically, that's not normally the case.
Awesome. Well, Michael, thanks so much for taking the time. I feel like you're just giving so many valuable nuggets to our audience and to investors. So for our investors, I want to say thank you for taking the time to educate yourself, because as you educate yourself, you're getting better. No one cares about your wealth quite like you do. So this is kind of the thing where you really invest into, how you're going to invest in the future and how you're going to develop yourself. So I want to give you a couple steps forward. If you're new to this and you're just not quite sure and you wanted some more information just as far as kind of looking at this asset class with multifamily syndication, Michael put together an awesome report comparing the returns of stock investing and the volatility there to multifamily investing. So that's at themichaelblanc.com/report. So it's just his website /report. You can go there and you can get this great free resource that you can check out. The second thing is if you're interested in finding about deals, you're like, hey, I want to be involved on your deal list, go to nighthawkequity.com. Click the join button. We'll establish a relationship with you and we can start to include you in future deals. So thanks again for taking the time, and we'll see you on the next video.
All right, hold on. Let me do a couple things.
Yeah. Do your fun stuff there.
All right. All right, like Bronson said, before you go, grab this free report right here. Very important. And make sure you subscribe to this channel so you don't miss any of these videos coming out every single week. And check out this other video.